Welcome to our final presentation on mutual funds, where we actually answer the question, how do you choose a mutual fund? And the answer is it ain't easy. But first we're going to take a look at fund families. We're going to take a look at the offerings of some of the largest fund families and how fund families work. Fund families exist when one investment company manages a group of mutual funds. And we'll take a little bit of a history lesson here. When the mutual fund industry was new, most mutual fund companies only had one or two mutual funds that they were running. There was one notable exception, Fidelity. But once these things started to become very profitable and very competitive, everybody started to compete with one another, and if one company created this one fund, the other companies had to follow suit. Some resisted that urge, but what we find is that these fund families have just grown in their numbers of offerings to just outrageous numbers of funds. And of course, the funds in the family vary in their objectives. You can move money from one fund to another within the fund family almost always with no charge. Sometimes they will charge you if you do excessive movements, as if you were not owning the shares but just renting them and then turning around and giving them back and then buying new shares. That's not what mutual funds are for. Right. And so they may hit you, go right ahead and do it, but we'll hit you with a 1 or 2% transaction fee. Or some of them just won't let you do it. They'll say, that's it, you can't do it anymore. Or they will say you can only do 10 a year or whatever. But so you understand you can move your money around, you don't have to pay the sales charge unless you do it too many times. But here's the kicker. If it's in a taxable account, then the IRS is going to say, hey, you sold the one investment, you bought another investment, you've generated a taxable transaction. And of course, if you have a gain, you have to report that. If you have a loss, you get to report that, although the IRS doesn't care if you don't report losses because it saves them money. If this is in a retirement account, a 401k, a Roth IRA, or one of the cousins and many variations, or an educational savings account or a health savings account, what the IRS calls tax qualified, then it does not generate a taxable transaction. And so some people would use their 401ks like casinos. They would buy and sell, and that's why the mutual fund companies put a stop to that, either by charging them, sure, we'll charge you to do it, or just not letting them do it, stopping them from doing it. And Forbes has great advice. This is from an old article. A long time ago they wrote this article, but I love this. Choose a family, not a fund. Right. Find a family of funds where the companies are well run, management teams, been great depth. They've been around for a long time, and stick with them. Yeah. Slide number 17. Here are the top 10 fund families. Now, the problem is when you go searching around for this stuff, you find that there's really a lot of disagreement about who the top the 10 are, and so you really can't trust any of them. I would have thought that the ICI, the Investment Company Institute, which is the trade group, would show a ranking, but they don't. They don't, and so you have to sort of trust somebody that you believe has got it right. And the problem is, of course, it changes every day. The market value of their holdings change every day, so it's a difficult act to do. But in general, the top 3 funds families are Vanguard, American, and Fidelity. And then it used to be that Fidelity was the number one for decades. And then Vanguard beat him out, and then American beat out Fidelity, but then Fidelity got bigger and beat out American, so these two might have traded places several times in the last few years, so who knows. The next one, so these three are very large companies and have been around for decades and are, all three very reputable companies. I'm a big fan of American myself, but Fidelity has a lot of great funds and Vanguard has a lot of great funds. PIMCO, now this is a little old. They have lost a lot of their business, so they might have gone down a little bit. PIMCO stands for Pacific Investment Company, and they're based in Newport Beach. And they had a gentleman by the name of Bill Gross, who was, he's still alive, but he isn't there anymore. And he was just unbelievable with his bond picking ability. And so their funds became very popular. And then he left. And so now a lot of people have decided that, you know what, I don't trust PIMCO anymore. Franklin Templeton is another very good group based in Los Angeles. Been around for years. And remember Sir John Templeton? Exactly. Right. He's no longer alive. He's no longer with us. But he made his mark. And Franklin Funds and Templeton Funds merged. Very good group. Very good group. Another great group is based out of Baltimore, T. Rowe Price. And they made their mark with international investing. But they do a lot of good domestic investing, too. And they're another great group. Columbia, I feel sorry. I know they might sue me. I don't know if no one's going to listen to me. But I don't like this group. I don't think they're a very good group. I really feel sorry for people who have them. I read their annual reports and they say, this is many years ago, so I don't know, maybe they've gotten better, but they would say things like, well, last year wasn't very good for us, but we're going to do better next year. Like, oh, sounds like the Padres, right? Anyway, my apologies. I'm not a big sports fan, so I'm just teasing. I don't even know. Do the Padres do well? I don't know. BlackRock. What a smart group. Whoa, these people are not dumb. They got the job of running the 401k for the federal government. It's called the Thrift Savings Plan. And they charge a little bitty money on each account, but they have over 4 or 5 million accounts. So, hey, not dumb. And they were one of the first companies to come out with the ETFs, the exchange-traded funds. Remember the exchange-traded funds? Yeah, so they're a smart group. And then J.P. Morgan, you've heard of them, Chase, right? Chase. They bought a bunch of mutual fund companies and merged them into J.P. Morgan. And I don't know too much about them, so I'm not going to comment. But Oppenheimer's another good group. It's been around for decades. They're based in Denver, right? They're based in Denver, and they've got some good global offerings. And so why do I tell you about this? Well, because these are just a few of the companies that are out there, and I'm trying to get you to understand that there are many good choices. There are many more that are not so good, in my humble opinion. But in the face-to-face class now, what we would do is we first show Fidelity offerings, then we show Vanguard, then we show American. There's a reason for that. Fidelity has 500 or so different funds. Right. And they're very smart. They've set it up so that any mutual fund can go through them. If you go to their website, there's a few different links that you'll see on the class website, but you could just go to fidelity.com and nose your way around on your own. You'll see thousands of mutual funds. Yeah, and about 500 of them are Fidelities, but then thousands of them are other companies, because other companies are looking at Fidelity and they're really, really big, and they're saying, okay, let's join them and allow Fidelity to sell our funds. And so when you see the number of funds, you just get this feeling of, what? That deer in the headlights stare where you just say, where do I start? Where do I even begin? And Vanguard's a little better, but they have a couple hundred. Actually, a little less, about 140 or 50 or so. And, of course, some of them are very popular. Their index funds are very popular, but they have some other funds that are actively managed, which are actually very good. There's one called, Prime Cap. Not one, a few of them. Prime Cap. Prime Cap is a company that is separate from Vanguard. They're a subcontractor, a sub-management. They contract out the management of the funds. And they broke off from American funds in the early 1980s. Now, why do I show American funds last? Because unlike many of the other companies, they have resisted the urge to create dozens and dozens of funds. So they have a lot that now are not really new funds. They're just sort of repackaging their old funds into little packages, or you can buy 5 funds just by buying one fund. But they really only have about 40 or so funds, and the cool thing about them is you can see them all on one page. So in the face-to-face class, I show them all the American funds on one page, and they go from the most riskiest to the least riskiest. And oh boy, can you see the total return going down as you go down the risk spectrum. More risk, more potential return, but also more potential loss. Less risk, less return. And if there's anybody who tries to tell you that you're going to get great return with low risk, just walk away. Better yet, run away, because they're crooks. I can guarantee it. Or they've self-deluded themselves. There's no such thing. It does not exist. It's like a jumbo shrimp or a straight curve. There's no such thing as a high return, low risk investment. And you really see that with you're starting with the most and they don't even have aggressive funds. They have growth funds, growth and income, equity income, and then the bond funds, the balance in the bond funds, and you see the return over decades going down and down and down, and that's what you will expect. And so on the website will be links to not only just various funds, not just American Fidelity and Vanguard, but Franklin, Templeton, T. Rowe Price, and one of my favorite companies is Dodge & Cox. They are very strange. They've been around since 1931, but they only have 5 funds, but every one is a great fund. You see, so they've resisted the urge to create more and more and more and more and more funds. They said, look, this is all people need. This is what we're going to offer. And they've done very well for their investors. Because of the mutual fund scandals of 2003, 3 of the companies that used to be amongst the top 10 are no longer here. What? Wait a minute, Piano. Did you just say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, yeah, as a matter of fact, I do, and it really isn't that bad. Since 1940, the Investment Company Act of 1940, the mutual fund industry has been regulated and escaped any hint of impropriety. You like that word, impropriety? It means hanky-panky, trucos, travesuras. Not good. Bad things. In 2003, some practices that were not quite illegal, they weren't illegal, but they were obviously unethical, were uncovered. And it was only a handful of funds, a handful of people. Just a few funds. There was only one. Poor Alliance. They had one fund, and 2 guys in that fund were playing fast and loose with the rules, and yet the whole company got tarred, which was sad because Alliance has got some darn good funds. Poor George Putnam, rolling over in his grave. Putnam almost disappeared, and it's a venerable old mutual fund company that almost disappeared after the scandal. And then the worst offender, or not maybe the worst offender, but the worst example is Strong Funds. The gentleman, and I forget, is it Richard or is it John Strong? I can't remember his first name, but he started this fund from scratch. He started this company from scratch. He built it up into he was worth $600 million at the time. And he made about $80,000 from his unscrupulous dealings. You're worth $600 million. $80,000 to you is chump change. Why would you do that? I don't know. I cannot imagine. And he was very contrite. He is barred from the industry for life. He didn't do anything illegal, folks. That's the thing. And you're saying, well, what did they do? What did they do? Remember we said that people were buying and selling their mutual funds like stocks, trading them. They weren't owning the mutual funds. They were renting them. He was doing that and a few other things that really weren't illegal. And so it cost the other investors a penny. Let's take a look at this. remember Enron? Some of you don't remember Enron. That was what, 12, 13, 14 years ago. But people lost everything. They had $100,000 and they wound up with $1. In this case, they had $100,000 and they didn't even lose $1. They might have lost 2 cents or 5 cents. But you got $1 million. Right, you understand? It multiplies. And so what would they do? Let me see if you can follow me on this, and I'll try to make it as easy as possible. The market tanks in the United States. All right, stock market drops precipitously. The market in the United States closes at 4 p.m. Eastern Standard Time. That's 1 o'clock our California time. In a few hours, I forget how many, 2, 3 hours, maybe 4, 2 or 3 hours, the market's going to open, no, probably 4. The market's going to open in Japan. Okay, so here's what now you got to know that mutual funds are priced at 4 o'clock Eastern Standard Time, New York time, every day. So you have a Japanese fund, it's priced at as if the Japanese market didn't open yet. So now what is typical is after the United States market crashes, the Japanese market's going to crash. So you sell your Japanese fund on that day that the market crashes in the United States. The next day, or the next few hours, Japan's market crashes, follows the United States. You then buy back the Japanese fund the next day. You see what just happened? You just picked up 1%. Or maybe not that much. It depends. It depends on how much the Japanese market crashes. So you're using the fact that there's a delay there. And it wasn't illegal, but it's obviously unethical. And that's why if you do that now, some funds will say, fine, we'll charge you 2%. We'll just hit you with a 2% fee and we'll give it back to your fellow investors. And other funds will say, no, you can't do it. If you sell your fund now, you can't buy it back for 30 days or 60 days. Or you can only do it 10 times a year. So you see, it wasn't illegal, but it was obviously wrong. And this gentleman was very upset. He was very upset with himself, and he said, look, I've ruined my life. I have dishonored everybody who works for me. I have dishonored my family. And for nothing, for him, $80,000. Somebody's worth $600 million. It's a tragedy, I believe. The vast majority of companies, folks, never engaged in any of these shenanigans. So don't think the mutual fund companies are scandalous. They're not. They're for the most part extremely ethical. Now, some of them don't return as great returns as others, but that doesn't mean they're trying to cheat you out of money. Slide number 19. Okay. Piano. How do I pick a mutual fund? You show me that there are thousands of them out there and dozens of companies. Well, it isn't easy. It really is not easy. I'm not going to lie to you. Here's my advice for what it's worth. You want to pick a mutual fund that invests in high quality stocks or bonds. Now, therein lies a conundrum, a puzzle, a difficult thing to quantify, because how do you quantify quality? It's not easy. Quality is in the eye of the beholder. But you know it when you see it. When they have invested in high quality companies that have long histories of growing their dividends, and maybe a few growth companies, to throw in there for spice, and maybe a turnaround that's been beaten down, then you know that they're doing a good job researching and deciding what to buy. If they're investing in the latest and greatest, the next big thing, that everybody jumps on and rides up as high as, then but that's the problem, isn't it? You have to decide what that is to you, what quality is to you. Is well diversified across several industries and sectors of the economy. What are the 2 reasons we buy a mutual fund? Professional money management and diversification. Some fund managers will concentrate their portfolio in 35, 40 stocks. It's great if they pick good stocks, but all we need is a few duds and it can really pull you down. Normally, mutual funds will have at least 100 up to 200 different companies. Has a long-term perspective and a manager, or better yet, in my humble opinion, a management team with many years of experience. You want to avoid companies that shuffle their managers like a deck of cards. This is what Fidelity was famous for. He called it the stars. He would have these people, he'd throw them in the mix and see how well they did. And if they survived, great, and if not, you're out of here. And it worked great for some of the funds. Peter Lynch, 29% over 13 years, not bad. But it didn't work great if the person turned out to be a dud. And it encouraged them to have a short-term time horizon because they knew if they didn't produce in 18 months, 2 years, they're gone. So now more companies understand that they need to give their managers much more time, much more leeway, and they're doing it. And you want a mutual fund that has been around for decades and performed consistently well in both good and bad markets. Don't tell me how well you did in a good market because I ain't interested. Any idiot, yourself, your humble instructor included, can do well in a good market. It's how you do when the organic matter hits the ventilating device. That's what I want to know. I want to know how well you do when the market turns sour. Because that, in my humble opinion, is going to color your long-term returns more than anything else. We know they're going to happen. We just don't know when. And we need to prepare for those both intellectually and emotionally. So now that we know what we're up against, let's take a look at a sample stock mutual fund. One out of thousands, because we got to start somewhere, right? And in the face-to-face class, we would pass out some handouts. And for the online students, for you online students, take a look at the chapter 13 part of the website, or, look in Canvas, and you'll see various things that we've pulled out about this one simple mutual fund, one single mutual fund. And what we find is that this thing's been around 83 years. Now, there's not too many mutual funds that have been around that long, although there are a few, I think, that have been around longer. I know there are a few, that I'm not sure exactly how many, but there are some that have been around longer. And remember when we said that we were interested in 8, 9, 10% over the long term from stocks? Some years are going to be better, some years are going to be worse. Well, these people, over 83 years, have done 12%. Pretty darn good, right? Exactly, folks. Now, I know some of you are thinking, I don't have 83 years. Well, that's why you'll see the illustrations that we'll discuss in just a little bit. But still, it's a pretty darn good commentary, right? It's a darn good what's the word I'm looking for? Sign or omen, or not omen, but it's cool. It's here are some. There are no. Oh, we'll take a look at some others. But what we find when we look at some of the materials that come along with this is that stocks, yes, in the short term, are very risky. There's a 1 in 3 chance in 1 year you'll lose money. But if you just extend your time horizon 3, 5, 10 years. It turns out that stocks have been pretty darn good. And then we take a look at another one that says, hey, what if we had invested on the worst day of the year for the past 20 years? How did we do? Well, it turns out, we didn't do as well as somebody who invested on the best day of the year, but we still did pretty well. So do take a look at these in Canvas or on the class website in chapter 13 section, and you'll be surprised. Now, this is a particularly good mutual fund that's been around a long time, and mutual funds that do well tend to stick around. Others get closed or merged into some other mutual fund. But as we'll see, there are others. What about market downturns? Well, they're going to happen, folks. keep a long-term perspective. Think long-term. I mean, assuming you don't need the money. If you need the money soon, it should not be in the stock market. Stock market stocks are a long-term investment, meaning 5, 10, or more years. But keep a long-term perspective and dollar cost average. Now, this slide, number 21, should look fairly familiar. It's from chapter 11. Dollar cost averaging is a horrible name, folks. I wish I could come up with something better. I wish the industry would come up with something better, but that's what they call it. It's a system of buying an investment at regular intervals with a fixed dollar amount. Now, that doesn't sound very exciting, but it's incredibly powerful because you don't worry about what the best time to invest in or the worst time to invest in. You simply put your $50, $100 a month every month. If you can afford it more, great. And you don't worry about the best time. In fact, it took me a while, but I finally convinced my wife that investing in stocks was not gambling. And I said, Anita, because that's her name, Anita, no matter what happens tomorrow, when we wake up, there's good news. And she looked at me and rolled her eyes, like many people do. The market's up. Good news. Yippee! Well, your account is worth more. Yeah, your $100 is now worth $100.25. Congratulations. The market's down. Good news. What? You talking about how the market beat? Yes. This is good news for you young folks. You want stocks to go down, because that means next month you're going to be getting $50, $100 is going to be giving you more shares. You understand? You want to buy on sale. Now, if the market crashes and stays crashed, well, that's a problem. Not because of your Roth IRA or your 401k. I mean, that's a problem. But the bigger problem is our system has failed. Yes, capitalism has cracked and fallen and dissolved into a pool of tears. And there's no food at the Vons, there's no gas at the Chevron station, no clothes at the Gap, the cell phones aren't working, SDG&E isn't pumping out electricity, the schools, the hospitals, the banks, the fire departments, the police departments are all shuttered. The trash isn't being picked up, the sewer's clogged. Are you going to be worried about your Roth IRA and your mutual fund that you're putting $50? No, you're not going to. I mean, failure is not an option. Unless we come along with something better, folks, which I don't think we're going to do. I mean, a lot of other systems of economics have been tried and haven't done so well. But who knows? Someday I'll run up the flagpole, see who salutes. No, you are in it for the long term. If you're not in it for the long term, folks, either you need the money soon and you shouldn't be in the stock market, or you think you're going to be able to outsmart the pros on Wall Street and buy low and sell high and do that over the course of days or weeks or months. All I can say is good luck. And don't use a mutual fund, by the way. Yeah. Take business 123, okay? So dollar cost averaging. Sounds boring, but it's very, very popular. I mean, very, very powerful. Very, very powerful. And in the investment world, as we said, boring is good. Slide 22. Hypotheticals. Now, here in the face-to-face class, we would run some hypotheticals on the overhead screen. You're going to see them in Canvas or on the Chapter 13 web part of the website, class website. And what you're going to see is another mutual fund, which is a stock mutual fund that is investing for growth. It's called the Growth Fund of America. How more generic can you get? And it's actually a very good fund. And we're going to see, with 83 years. Most of us don't have 83 years. So we're going to see how we've done for 30 years, $100 a month, 40 years, $100. Sound familiar? Yes, this is what we did in Chapter 11 for bonds. What we did for Chapter 12 for stocks. Wait a minute. No. We did the Growth Fund. I'm getting confused. The Growth Fund of America, we did that in the previous chapter. Right. We're doing the Balance Fund. I'm getting old. We're doing the Balance Fund here in Chapter 13. Okay. I think I put GFA on the next slide or so. So, yes, these mutual fund hypotheticals are not guarantees of the future. They're looking at the past. They're going back and seeing what would happen if you'd put $1,000, $10,000, or for most of us working grunts, $50, $100 a month away. And they must be approved by the Securities and Exchange Commission and the Financial Industry Regulatory Authority, and contain all kinds of disclaimers. And if you've already looked at these from chapters 11 and 12, you'll know what I'm talking about. Be afraid, be very afraid. And then in the face-to-face class, if somebody says, "Oh, run it for this," and I throw one up there, and I think in this chapter, there's one for people who are in their 40s. Who need to put $500 a month away. Yeah. And they don't have all as much time as the millennials, as the younger folks do. So that's a sad thing. But that's the truth. You hear people come up to me and they say, "Why didn't you tell me this 25 years ago?" I'm like, "Oh, sorry." Okay. So, slide 23. We showed you the Investment Company of America over 83 years, and you say, "Well, it's just one mutual fund." No, it's not. Look at all these. Does this slide look familiar? Yes. From chapter 1, when we started this whole shebang and said, if you put away... And so here are mutual funds. Now, a few of them a little bit less than 10%, but not much less than 10%. And this one is amazing, folks. A utilities fund. If a utilities fund returns 6-7%, you salute it and you say, "Fabulous, thank you very much." And this one's done almost 10%. What's going on in Franklin? They're brilliant, those folks. And you'll notice there are some companies that we've made mention of already. There's good old T. Rowe Price and Franklin and Vanguard's in there, and then the American funds are in there, but they don't call themselves the American funds. There's American Mutual Fund, Investment Company of America, Washington Mutual Investors Fund. Oppenheimer's got one that's been around for over 50 years. Mutual Shares, that's another Franklin. Templeton, that's another Franklin. Franklin's a very good company. And then we got a few Fidelity. And then Dodge and Cox, who are they? They're a little strange. They only have 5 funds. They're really strange, but they're a great company, folks. They're a great company based out of San Francisco, but you watch their videos, and these people look like they are from St. George, Utah. They look like they're from Topeka, Kansas. They do not look very urbane or very sophisticated as you would expect from somebody from San Francisco, but no. They're not too shabby, though. Their returns are pretty darn good. So you see, I think this is a pretty good sign, don't you think? And what you're going to hear people say, don't pick a mutual fund that tries to do research. Nobody can beat the market. Just buy an index fund. That's what you're going to hear from a lot of people, folks. And you know what? They're not lying. But they're not telling the truth either. They're saying that no one can beat an index fund. And the truth is there have been companies that have done it over decades. 1 or 2 years you beat it, that's just luck. But when you do it for decades, that's not luck, folks. It is not luck. Because that's what they're going to say. They say, "Well, this one's beat the index. It's just lucky." Wrong. They're absolutely wrong. They do not understand statistics. They say, look, if you put together 10,000, let's say 11,000 mutual funds, and you, first of all, but not all of them are stock mutual funds, but let's say 11,000, and you just let them randomly choose investments, like throwing darts at a dartboard. You've heard the saying, maybe monkeys throwing darts at a dartboard. Then, one of them, a couple of them, statistically, are going to do well. Well, that's true over the short term. Yes, luck is important over the short term. But over the long term, they're absolutely wrong, because you start running the actual statistics of what it would take for somebody to do that for 50 years or 60 years or 80 years, and it turns out that the odds are astronomical. 1 out of 15 million might do it. Not many out of 1,000 or 10,000. So don't let anybody tell you it's luck. All right? These people did their homework. They are good at what they do. And it isn't cheap, folks. If you run a mutual fund well, if you do the research, global research that you need to do, you're not going to be doing it on the cheap. It's a very expensive proposition. So if they do their job well and they give good returns over time, then they're worth the money that they earn, and they do earn very good money. Some studies have been done, and what they found is that the companies that tend to do the best have three things in common. One is they tend to have lower fees. Not necessarily the lowest fee like an index fund, but they tend to have lower fees. And that's, it makes sense because you have to beat the market, you have to do as well as the market and then do more. You have to do more to just pay your fees, right? They tend to have good downside resilience. What does that mean? When the market goes down, they don't go down as much. Now, maybe when the market goes up, they don't go up as much, but they don't go down as much when the market goes down. And we call that upside downside capture. And in the BUS123 Introduction to Investments class, we asked the students to research that. And then the third factor, which is one of the crucial factors, is they tend to own their own investments. In the industry, we say they eat their own cooking. They don't just do the mutual fund and then they do their own investments. They buy their own. They don't buy your investment. The investments they're working on. No, they eat their own cooking. They own their own mutual funds. So those three. Look for those three things. Okay. All right. So, and of course, if this piques your interest, folks, don't forget BUS120. I know it. I've already told you that. All right. Okay. Continuing. So, what's the bottom line on mutual funds? Choose a fund family, do a lot of upfront research, or get a recommendation from a licensed individual who you trust. Stick with them, because there's a saying in the industry that has been proven statistically. Most mutual fund investors do worse than the mutual funds they invest in. How can that be? That doesn't make any sense. How can you do worse than the mutual fund than the investment you invest in? It's very simple. You wait until the market hits, 100% return in the last few years. It's gone up 30% last year, 40% this year. The sky's the limit. They're going to the moon. Ooh, is it too late to get in? Yeah, it's too late to get in. Well, Joe Investor sends his money to the mutual fund just at the worst possible time, right before the market crashes. And then you hear him say 3 months later after it's lost 30%, ooh, is it too late to get out? In both. Yeah, right. I hope that sticks with you, folks, when you hear people say, oh, I just made 70%. Come back in 6 months, see how he's doing. Reevaluate them periodically, every 6 months, a year, but make changes judiciously and sparingly. I love those words, judiciously and sparingly. It's not a sprint, it's a marathon. As you approach retirement, migrate from stock funds to bond funds, but don't give up on stocks entirely, folks. Don't give up on stocks. Remember that stocks over the long term, assuming the world doesn't end, will give us the best return, and they give us growth, which is what we need if we're going to live a long time. And use dollar cost averaging. $50 a month, $100 a month, whatever you can afford. $25 if you can afford that. How much is your cell phone payment? But for the most part, you forget about them. You don't worry about them. The PETA factor. I know it makes investing boring, but it works. Don't you want to be bored to wealth? I hope so. Now, we're done with all the investment material that's in our book, but as we said, there's one last chapter that was taken out of the previous book, but I thought that was an unfortunate thing because real estate is a very important choice for many people, And the others, I will do my best to convince you otherwise to stay away from the others. But maybe they are for you. Everyone's different. So we'll see you in our last chapter on investments, which is not in the book. It's from lecture notes called Real Estate and Other Investment Alternatives. But aren't you happy about mutual funds? Isn't it great to know that there are people out there that have done a good job, that will invest on your behalf and make you a ton of money, and you don't have to do anything. All you have to do is send them $50 or $100 or more if you can afford it, and then come back 30 years, 40 years later and say, thank you very much. I'm ready to go around the world. Okay, stop. See ya.